as well. So we have my colleague Anthony already here. So thank you again for being here. And as I said, this web seminar will be recorded. If you have questions, you can put them easily in the chat, and we will address them after the presentation of Anthony during the Q&A. The presentation slides will be shared by me in a PDF format, I think this week or next week, at least after Easter. And if there's further questions we cannot address today because there's not enough time, we will see if we can answer them via email. So this would be already everything from my side. I hope you can see and hear me well, and I welcome you again. And I would already now hand over to my colleague Anthony. And Anthony, you could start sharing your screen. I hope it works. If not, I have the presentation ready as well. Yes, perfectly.
Can you see it?
Yes, works perfectly fine.
Then, yes, warm welcome from our side to everybody. My name is Anthony Salang. I'm a senior project manager and innovation advisor by the Steinbeis Europa Center in Germany. And today will be about how to become investor ready for an SME. The focus has been put more on startup, but it is valuable also for all the kind of SMEs because there are some mechanisms that are quite common. I will just shut down my camera just to assure the stability of the network to avoid some problem, but I'm still here. Okay, so external investment is often needed at some stage of the venture life cycle of the companies to allow this company to grow and to make their innovation projects realizable. But being investment ready depends on many different factors and parameters that should be here to convince the investors that the business of the company will be profitable and has chances of success. It's all about making the business ready to meet the expectations of the investors. And the aim of today will then be to give you an overview of the different steps you have to make to convince the investor to invest in your companies. So we'll begin with a first overview of the different kinds of source of finance, really an overview, the typical venture life cycle, the framework that is needed for the decision analysis, the key factors for the investment decisions, and then we'll enter into a really big part of the webinar that will be on the 5 major steps to investor readiness, mainly the definition of the company strategy, the financing plan, the valuation of the company, choosing the right investor because they are not the same for all the steps of the company, and managing efficiently the negotiations during the fundraising campaign. So let's start with the different sources of finances. There are many different sources that exist for companies that develop innovative products. They are grouped into 3 main categories. The first one is the debt financing, the second, the equity investment, and the third one, the grants and the subsidies. Regarding the debt financing, it is when an enterprise borrows money for working capital or capital expenditure by taking up a loan against an interest on the debt. There are many different mechanisms in the debt financing. The most common one are the secured, unsecured loans or credit given by the banks. But you can find also the friends and the family that support the entrepreneurs, the microloans that allow sometimes to buy specific equipment, the leasing, the crowd lending for now, and for the bigger company, the bonds also that are an important source of investment. Then you have the equity investment. This is when an enterprise raises capital for business purposes through the sale of its ownership's right. That means giving shares on the company. There are multiple investments that allow that. The most common are the venture capital, the business angels, the crowd investing also, or strategic investors, or also the own resources of the companies when it's already well established on the market. The third category is mainly the grants and the subsidies. So these are mainly funding that are given on specific projects. These are public money that you can have on the European level, the ERDF funds, the IC, Horizon Europe, for example, the national funds, but also some regional funds. So we have many sources of funding that are available, but all are not totally suitable to all steps of the venture capital. Basically, a company is growing in three different phases. The first one is the research phase, when the technology is developed and when the company is making its intellectual property right assessment and management. Then you have the early stage phase, when the company enters on the market and begins to sell the first product. And then lastly, you have the expansion phase, where the company faces to competition, growth, and expands also its capital and so on. And for each phase, you have different kind of mechanisms that are more appropriated to find the funding. For example, the grants is a bit an exemption, because they can be valuable at each stage of the life cycle of the company, depending on the type of grants you are requesting. At the early stage, you can see that the main mechanisms available are mostly the business angels and the crowdfunding, because this phase is really highly risky, and these are the main that are financing the main risk. And when the expansion phase is coming and larger amounts of money are needed, then come into the play the venture capitalists and the private equity. So there are three really important elements to take into consideration in an enterprise before going to ask for investment. The first one is the level of innovation correlated to the level of risk of the company. They are both strongly linked, but this does not mean that a company that has a lower level of innovation does not have a high level of risk. It depends also on all the conditions of the market. Sorry. The second aspect to take into consideration is the size of the enterprise. It's clear that large companies will find easier to raise debt with the use of bonds, whereas a small company will have more chances to go to the business angels and have small amounts of money. And of course, take into account the amount of money you are requesting, because from that will depend the right financing source you will consider, because all the type of investor do not invest the same amount of money. But we'll come back to this a bit afterwards. There is then a framework allowing to decide the decision, some factors that are really important to take into consideration. The first one is the stage of the business development. Is it a recently or not yet established company? Is it an established company willing to expand? From that, the type of investor will be different. The level of risk of the company, we already talked about that. The likelihood that the business idea might not succeed. When you have a really high risk, sometimes you will need to get more remuneration to the investor, a higher interest rate or a better exit strategy. You have to see the simplification of the goals. Are the goals really simply achievable? Explain them clearly to the investors. You have to consider the financial gains you will have to give to the investor. They have clear expectations. They provide finance. And if they are asking, giving you a debt, you have to pay interest rate afterwards. If they make an investment in the capital, this will have a multiplier effect to the business valuation afterwards. So this is really an important question to take into consideration. Then the time to ask for the investment, is it too early? to invest? Is it too late also? How much finance to request? The amount you have to request has to be exactly the amount that is needed. And then the last point is really the valuation of the company. It is really a critical point in the negotiation process. If the valuation is too low, the investor will request a significant amount of shares, or either will reject the debt because he will not make enough money with the company. And if the valuation is too high, the deal cannot be concluded often because other deals will be more attractive because the high valuation incorporates too high level of risk. So now that the basis is a bit described on the context, let's enter more deeply into the different tips that will make a company investor ready, or at least help you convincing the investor to invest in your business. For this, I have 5 different parts, with the first one that is really a big one, that is defining the strategy of the company. It considers such aspects like the market position, the way you will enter to these target markets, the evolution of the product, the market traction, what is the exit strategy for the company, and the alignment of the founder team. Afterwards, we will see some other mechanisms that are important, such as the financial plan to convince the investor, how you can explain the valuation of the company and which is the right investor also for the company, and how you manage the dynamics in the negotiation and achieve the best result. So let's start with the first point, which is the definition of the strategy. And the really first point is to define the market position as well as how you will protect your market position. Underline is how to convince an investor that you will be well positioned on the market and that you will be able to keep your position over a long time. 3 aspects have here to be considered. The first one is the maturity of the technology with the technology readiness level scale. The second one is the maturity of the business with the business readiness level scale. And the third one is the unique selling proposition. What is making your business unique for the investor? The technology readiness scale defines the maturity of the technology of the product from the idea to the product placed on the market. It is well used by public funders, such as the European Commission, to evaluate the readiness of the product. Basically, the startup will enter into the play from level 5 when the technology has been developed by the research. So you see that we have 9 levels in the scale, from the basic principle, basic research done, then the technology development in the lab, then the operational development of the product and the demonstration in the operational environment, and then the entry on the market with the final product. The progression in the level scale is really often associated with the protection of the technologies through intellectual property right means that will have a big importance afterwards in the protection of your markets and the valuation of the company. For example, having patents protecting your technology is definitely a proof for investors that you protected your market, and in case of needs, the IP can be sold to other companies as an exit strategy. Licenses can also be interesting to expand market geographically by generating revenues with the license fees. So do not neglect the importance of the IP for a company. The second level, I would say, will be to assess the business readiness level of the enterprise. This is basically done with a scale with 9 levels, grouped into 3 main categories. The first one is the business conceptualization. That means that you are building a business based on a perceived need. You have a candidate product, service, you collected evidence from your clients, and you have an idea on how to generate value to them. Once you have that, you enter the next phase, which is testing the business. You involve closely stakeholder or even early adopters of the product. Your objective is here to measure, evolve, if your actual processes match with the needs of your clients. And then, once the tests are done and successful, you go into the business deployment. That means you consolidate the paying customers and the product service offering in the long run. In this step, you become a trustful business for your client, and your cash flow starts to become more predictable. The next step will be to convince the investor that want to invest into the company, into the business, that your product offers a unique benefit to the customers, a quality improvement, a lower price, or an increase in the efficiency due to technological advance. For this, competitive analysis is a must and is really necessary to assess the strength and the weaknesses of the competition, and relates them to one's own business concept. There are some major questions to be answered, such as who are the major competitors, what are their competitive products, what are the strengths and weaknesses of these competitive products or alternatives, and what are the weaknesses of the innovative company in relation to the major competitors. So really, having a unique selling proposition like this is highly reducing the risk for the investors. That means it describes your innovation and allows to differentiate it from the competitors or alternative. It will reinforce the fact that you are unique on the market and that you have chances to have a good position with your innovation against these competitors. Once having defined correctly the USP, the unique selling proposition, and the status of the product, companies should be able to demonstrate the market traction to the investors. There is simply showing if there is a market for the innovation, is there market demand. Approved market traction will highly reduce the risk for an investor. So the more market traction you can demonstrate to the investor, the less risk they will have in the investment, and the more they will be willing to invest in your company. An adequate market traction varies at each round of the capital of the company, simply because companies have limited resources to demonstrate this market traction. One of the major reasons is that first, you are raising capital because you want to grow your current market traction. And when you are at the beginning of the fundraising and the beginning of the life cycle of the product, you cannot simply demonstrate this market traction because you have limited information. You likely don't have a product developed that is ready for the market. So the traction in form of sales is not here at the moment. However, you can show the potential traction by demonstrating the size of the market and the trends that support the product and the solution. It's also possible to show the market traction through primary research, such as surveys, conversation with potential customers, partners, to help validate the value proposition. When advancing in the life cycle of the company, going to the expansion to the early phase, you will need to take your market traction at the next level to convince the investors. This includes obtaining some beta testers and ideally some paying customers, and a need of a full-scale marketing plan, but we will come to that in some minutes. Lastly, when raising larger capital from venture capitalists or institutional investors, you need to show how you will scale the business. But at this point, you want to deploy the capital in raising earlier rounds to not only show that there is a demand for your product, but that you can scale the product, grow the company. And for this, the strategy has to be shown to the investors. So once the market traction is demonstrated, you show that you have a market for your product. Many business fail because they did not reach their customers. Also, they were there, they had a market traction. Then to have an efficient business strategy, it is really of prime importance to define well the market entry strategy. This contains easily all the elements that will show how you will reach your customers and clients by all possible means. It is easiest to focus first on an attractive market niche, big enough to start access customers and to extend afterwards in future phases. The main method that is used to describe this market entry strategy is the marketing mix. So the basic one is the 4P marketing mix, which stands for product, price, placement, and promotion. And for intangible products, such as services, it can be extended to 3 further aspects: the process, the people, and the physical evidence. Try to summarize the lot of information on this slide. On the level of the price, this is simply the price level you will sell your product, your innovation, the differentiation compared to the competitors, the conditions for this price, and the discount and allowances that you will provide with the product. On the product side, you already described the innovation content, the unique selling proposition, but it's worth to define also the different product lines you will have, the quality level you are positioned on, and the warranties you will provide with the product. The placement is simply how you will distribute your product. Do you have your own distribution channels, or do you need sales partner, retailers, distributors, and so on? Meaning, is it a direct or non-direct distribution? And are you distributing locally, only in your region, nationally, or even widely in the Europe? The promotion is all the mechanisms that allow you to communicate with your customers, to advertise. So are you going to advertise through the TV advertising, the radio, magazines, only in specialized shops, or even with internet campaigns, which is often really done nowadays. On the 3 last aspects, which are more relevant for the services, you have the process, which describe all the different work steps and the customer integration into the service, which is really important. The physical evidence are simply the facility design, the equipment you have, and all the certification that are needed to reassure maybe the customers. And last but not least, a really, really important dimension are the people. You can have the better product you want, and the company is making money. If you do not have the people behind and do not reach the customer, you will have nothing. So take care of the employees, assure their motivation through rewards, work environments, and so on, and educate and train your customer to use also your product to show them that they are important for you. Once the marketing mix is explained, so we saw this is a really, really important tool. Investor will like also to have an assessment of the viability of your product in the long term, as well as their evolution. They rarely invest in one-shot companies. Product evolve over time. The characteristics of an early stage product are quite different from those of a mature one. For strong product, the phases of growth usually resemble such an S-curve, where you have an early phase where the sales are growing really slowly. Then you have a growth phase when the sales are most important, followed by an hyper growth phase, a period of exponential growth. And after maximum growth, you begin the mature phase when your project attain easily its maturity, during which there is little or no growth. So this is important also to provide an idea of the possible curve your product will follow, because that will be more convincing. But more than that, it's also important to show to the investors how you will continue to grow your product after hitting the maturity. You must diversify your portfolio and increase your total addressable market to grow the business further. This could mean entering new markets, launching new features for the product, launching new product, etc. Growth of additional product or in new environments will again follow each an S-curve, here for the third product, with the same characteristics. So growing slowly at the beginning, fastly in the middle, and fast no more growth by the end. And by diversifying the portfolio of the company, you are overlapping the different S-curves and allow the company for continuous growth. You can have the example, for example, of the telephone companies nowadays that have S-curve that are really fast, because they are almost every year a new model with new features, new product lines, and so on. In parallel to that, you should be able to present also to the investors the product roadmap, meaning all the future evolutions that your product, as well as the timeline, you will follow. For example, the future investment to allow the roadmaps to become reality. This leads to answering to new questions to the investor, the time frame of the next release, maybe, even if they are just evaluation, but try to be realistic. Give some description of features that are being built, or the future problem that have to be solved. The next step in the investor strategy is on the exit strategy for the company owners. There are many ways. I will not enter completely into the detail because it would be too much complicated, I think. But the basic strategy to exit from a business are the initial public offering, meaning establishing a stock market launch in which shares of the company are sold to institutional investors. The second mechanism is the trade sale. That means the management simply withdraw from the business and sells it to another company, mostly from the same branch, generally. Secondary sale is the same, but the shares are being sold to another company from another branch. The buyback, that means that the founders buy the shares of the company back to the investors. The merge and acquisition, which is the most classical model. That means you merge the company with a similar company, or you are being bought by a larger company. Make it your cash cow. That means you have the business with a steady revenue stream. You pay off the investors. You find someone you trust to run it for you, while you can use then the remaining cash to develop the next idea. And what's interesting is that you retain the ownership of the company, and you enjoy simply the annuity of the business. Last but not least, important points to convince the investors and define your strategies to show how the team of the company is aligned. An aligned team is a team that aspires to achieve the same visions, understand the goals, make go in the same way and understands how they can contribute with their strengths to the goodness of the company. It's really an important point because an aligned team lead to many benefits in a company. It's improved the productivity, it's improved the performance, the communication, it gives higher motivation to the people. There's a lower rate of staff turnover. There is an increased efficiency to achieve the goal, better ability to make the key decisions faster, and big agility to adapt to a changing market. So that was it on the side of the strategy. The second point, showing that you are ready to an investor, is a convincing financial plan. Having a good product is good, but it does not make everything. A convincing business model associated to realistic financial plan showing the expected revenues is really worth. Do not forget that the investors are expecting rewards on their investment. This is not a free service. If they are convinced that the business will make money and will be profitable, then they will be more keen to invest into your company. For this, you will have to show them financial statements easily. The balance sheet, the profits and loss account, the income statement, the cash flow. For startups, the cash flow is more the key items for the management to check solvency. And you have also to take care of your burn rate. So the burn rate is a value that is normally used to describe the rate at which the company is spending the venture capital to finance the overheads before generating the positive cash flow from the operation. It's simply a measure of the negative cash flow. It measures how fast the company is spending the investment. So it is really a capital value for the investor. I put here an example of data that we need to give into profits and loss account to the investors. This describes basically the financial plan of the company presented to the investor. Generally, these items are followed on a monthly basis in the first year of operation, on the quarterly basis in the second year, and afterwards on a yearly basis after the third year. But it's really important because calculating all these elements will lead to the calculation of the cash flow. And then if you accumulate the cash flows on many years, you can have the cumulative cash flow that gives you an idea of the funding gaps for which you will require capital from external funding. So this is really the financial plan of the company is really important for the investors. Once you have then a good product to define, you have a market, you have something really nice. You have a financial plan that is sound. The next step is to explain the valuation of the company. Valuation of the company defines the value after the success and the investment. The value is not only the financial revenues, but contains also the know-how, the IPR, and other relevant aspects giving a value to the company. In general, we can value the company on an absolute basis or on a relative basis. The absolute valuation models try to find the true value of an investment based only on fundamental values such as the dividends, the cash flow, the growth rate for a single company, and not worry about any other company. The relative valuation models try to compare the company in question to other similar companies. This involves calculating ratios and comparing them to multiples of other companies. So there's many methods that are existing and that are validated in the investment world, but I have no time to enter into the detail of them. So now maybe one of the important question also is which is the most important investors for you at the moment. I would say it depends on the phases where your company is at the moment. So it's clear that from the research and the early growth of the company, you can count mainly on the crowdfunding sources, the business angels, and the peer-to-peers. When you are in the expansion phase, you will go mainly on the private placement, the private equity, and the venture capitals. And the next push, when the company is really, really successful and becomes to be big, then the debt market and the IPO. The banks is a bit an exemptions. They can be from the early growth there with different kind of mechanisms. And you have also the own resources and the retained profits of the company that can be injected as investments in the company. I put in the presentation an interesting table that was developed by the working group of the Enterprise Europe Network, Access to Finance, that is showing different sources of funding that can be used according to the level of risk of the company, low, high, the company size, micro, small, medium, large, and the amount of money that is requested. And we can see here, for example, that if you are looking for a business angel, it's clear that they are more helping micro to small companies, requesting either small, large amount of money, but with a high level of innovation. So let's talk fastly about the 4 different types of investors I selected. The business angels that are providing capital for business startup, usually in exchange for convertible debt or ownership equity. They give support to companies mainly at the initial moments where the risk of failing are relatively high and when most investors are not prepared to back them. What is interesting with the business angels is that in addition to the equity they supplement, they can supplement this investment with expertise and support in management, marketing, and networking. These are usually successful business people who understand the risk and generally invest between 20,000 to 250,000 euros, usually within a portfolio of investment. They can make a syndicate for a larger amount of investment. And their main aim is to support companies with a high growth potential to achieve the success. So there are many different types of business angels depending on their competencies and the amount of money then they can invest. The second type of investment is mainly by the banks. So these are the classic credit lines and loans for working capital and for investment. All through investment by the banks is not really always interesting for SMEs because the interests are quite high and the risk is really often too high. Banks can be really important because they have really a huge network with different institutions such as the microfinance institutions, the crowdfunding platform, business angels, economic chambers, consultants, lawyers, and they have a really good overview of the regional financing ecosystem. So either if it's not to get an investment directly from the bank, it can make sense to contact them so that you can be directed into the right person into the network. The 4th kind of investor is the crowd through the crowdfunding. So crowdfunding is loans or equities So the company that needs investment receive money from the crowd on less formal condition by selling their ideas or project to a group of lenders or investors. There are three main kinds of crowdfunding nowadays. The first one is rewards-based crowdfunding. That means you give a gift to the customer against the investment. The second one is the peer-to-peer lending. That means they support you with money and they get interest on the debt. And the third one is the equity crowdfunding. That means they get a share in the company for the investment they made. The last kind of investor I wanted to present is the venture capital and the corporate venturing. Venture capital is a form of private equity and a type of financing for companies, small businesses that have a long-term growth potential. They basically begin at 250,000 euros, but generally is more $500,000 the start investment. And you have a special way of venture capital, which is the corporate venturing, where established companies make investments in new businesses. And this is usually a way to acquire access to new technologies or market. This can be directly or through special funds. And some big players, big industries have also special venture capital departments to acquire share in companies and then expand their influence and their portfolio. The last step in the investor readiness is more on how you can manage the dynamics in the negotiation and achieve the best results. Do not forget that the process of raising investment is really long. It's almost 6 to 12 months, and that the venture capitals investors are really hard to convince. They will say if you go too early for the stage of investment or if you have too risky. So the main things to do before asking to an investor is to do the research on the investor you choose and the VC funds. Is it a sector that they have interest in, you are working in? What other companies are in the portfolio? Is there a conflict or alignment to the portfolio? If they are already working with one of your competitors, it makes maybe no sense to go to this specific investor. Are they currently investing with available funds? Because they have also limited amount of money to invest every year. And if they have already invested a lot, they will not be able to invest in your company. That's clear. Be aware also on the cost of raising investments. So you can do everything on your side, but sometimes it's good to have some outside external consultants that have a cost. The charges to the pitch, the charges to produce the video or the online presence, the success fee you will have to give to the outside consultant, or the legal fees also to prepare the contracts with the investors is also something that costs money and that has to be anticipated. The last one is to plan the investment raising strategy to maximize the funds available to cover the investment cost. Take into account that the first 2 months of a fundraising campaign is talking to as many individuals, groups as possible. And the rest, normally, when everything is running fine, is more about the due diligence of the company. Set everything correctly from the start, so the due diligence is simplified. As I said, investors want to get back rewards. They will invest large amount of money, so they have to see evidences. So show them the regular management account of the reporting, the cash flow, the sales projection, the director and staff contract have to be well established, the sales process, the contracts also have to be well established, and have a sound IPR strategy also to convince them that you will secure your market. And then talking to the investor, craft your pitch deck. Do convince the investor of why the market opportunity is large, tell something that is memorable and interesting, more a story that shows your passion to the business. Show that you have more than just an idea and that you have got early traction already on developing the product, getting customers, and to have a soundbite for investor to remember you by. You have to make a really good impression. My last slide for today is on some do's and don'ts when dealing with investors. So have in mind that this is sometimes really difficult to attract the funding when the company really needs the money. So you have to think ahead and plan the fundraise well in advance. Don't come to investor at the last minute, because if you really need the money, they will be less keen to invest in you. Take advice from people who have done it for similar business, or by consultant also that can make a great job. Work out exactly how much and what sort of funding you will require. Plan who it is appropriate to approach, which kind of investor. Provide them the information they are looking for in the format they want. Go in their direction. Communicate effectively, honestly with them. Summarize the objective of the business with impact and conviction. Ensures that the company objectives have a commercial focus, because they are not evaluating a product, they are evaluating a business. And that's the thing, you have to sell the business and not the product. And I will finish on a citation from a guy that is well known in the investment world, that the best investment you can make is in yourself. So trust you and be convinced about your job. Thank you very much.
Thank you so much, Anthony. This was great. Also for me, I learned something, definitely, which is good. I will share my screen again, so that we're already in the Q&A phase, and we will see if there's no questions in the chat so far, but maybe there are some, or some came up in the meantime from our participants. So yeah, to all of you participating today and having listened to Anthony and all the interesting things we have heard now, are there questions? Do you want to raise something? Do you want to discuss something at the moment? We will have maybe 5 more minutes for a quick discussion. Otherwise, of course, we will share the slides, and I would ask you to either raise your hand now and unmute yourselves to address the question, or write it in the chat and we will pick up from there. But often it is also that there's a lot of input and people need to catalyze it firstly. So we will see. Do we have questions? So far not. If you have questions, put them in the chat. You can also put them in the chat and we will address them later on. Is there something, Anthony, is there kind of one last advice, or do you want to focus on one last thing you can give the people for the afternoon to think about?
I think so I was really fast. I'm sorry, there's a lot of information, but it's clear that there's a lot of information sources. But the most important is really mainly the end. So this is a business that you have to sell to investors, not a product. So you can have the best product in the world. If you do not know how to make business with it, you will not convince any investors. So this is really all the factors that have to be thought together. And maybe just add that I know these are a lot of information to digest, but we are ready also to answer the questions afterwards. If you have the question after the seminar, when seeing the seminar once again on the platform, you can keep in touch with us, and we will try to answer to your question afterwards without problem.
Perfect. Thank you so much. I will also have prepared something so that we have that you have our email addresses as well. So Anthony's and mine at the end, and of course the relevant things for the Metabuilding platform as well. So yeah, the one thing I can do now is thank you again, Anthony. As far as I see, there are no questions and people need to digest. But it was really a good information. So really also for me, I learned a lot, even if I have worked with startups and also have done kind of a challenge for winners quite often in other jobs. But it is often really good also to hear it again and see, okay, what should we do and what can we also address with SMEs or startups? So there's also, if you need for all participants something from Steinbeis, you can also reach out to us, to the Steinbeis Europa Zentrum, and Anthony and me, you have our email addresses. So if we can help you also in your sector or for your business, then just reach out. Yes. And yeah, with this, I can only thank you, and hopefully, yeah, you got something from this webinar, and I wish you all a wonderful afternoon. We have thanks in the chat. That's great. So I think, Anthony, you have done a wonderful job. Thank you again so much.
Thank you. Thank you for organizing. Bye.
Thank you so much. Bye. And yeah, take care. Have a wonderful afternoon.